Are we good? So far, so good? Are we done yet? No. Armando, what number are we missing? Are we missing? We're missing at least one that I'm aware of. UC2. See, which one do you want to help us with? You get to choose. Choices. Depreciation on plant and equipment. Where's that going to go? Would it? Why would it go there? Income statement. Is it a product cost or a period cost? That's the first question you want to be thinking about. Is it in the factory? Then we're going to call it a product cost. So is it in the factory or not in the factory?
It's in the factory.
It's in the factory. Good answer. So does that mean it's a product cost or a period cost? It's a product cost. And so that narrows down our choices a little bit. And it actually eliminates your suggested earlier answer. Okay, so which T accounts are going to go into? Absolutely. What? Sorry.
It's an expense. Why would it go on the income statement?
Why would it or would it not?
Would it not?
Depends on what type of an expense it is.
I thought you always factor expense.
But ultimately, well, isn't it? Manufacturing overhead is an expense.
No.
Manufacturing overhead is an expense, but we've got to go through this rigmarole to determine how much cost of goods sold to put on the income statement, which is an expense. So, no, it's useful to know. I mean, it is very, how many expense accounts are on the board?
2 or 3 of them.
3, 4 if you include this one. The income statement is actually kind of a dual account, revenues and expenses. So if you include the expense side of the income statement, there's actually 4 expense accounts on the board. Direct labor and manufacturing overhead we've already discussed. And then what else? What's the third one? The fourth one's income, the debit side of the income statement. What's the third one? Cost of goods sold. Very good.
So you're saying depreciation is not always an expense?
It absolutely is. Depreciation is always, yes it is.
So eventually it'll be taken off.
Bingo. Eventually it'll get to the income statement, but not necessarily immediately. That's a good way to think about it. Because immediately it goes to manufacturing overhead. Okay. How much, Armando? $100,000. Now this one, what's the other side of this journal entry? Megan, do you know? What's the other? Yeah, Megan, yes. Megan, you're Megan Schill. Do you know the other side of this journal entry? Or Armando, do you? Are we going to credit cash? This one's the one that's going to be different. I'm sorry?
Then why would you, if it's going to be debit, why would you do that?
Well, we're debiting manufacturing overhead, that's correct. But what's the credit going to be? When you record depreciation expense, what's usually the other side of that journal entry? Don't remember from your last accounting class? Has it been a while? 3 years. Armando, do you remember? Precisely correct. Accumulated depreciation. Which I'm sure is what all of you were going to say as well. Yes? Is that what you were going to say?
No.
Well, I appreciate your honesty, and I'm glad I didn't call on you. Or maybe you're glad I didn't call on you. One or the other. Yes, sir.
Are you also supposed to do something with like the value of on books or something like that of the current item that you're depreciating?
Well, that's kind of taken care of in the sense that we just changed the value of it on the books. As soon as you write that journal entry, its net book value has been reduced by $100,000. So in a sense, we already have. And I'm not going to be focused on that for the most part in this class, but in effect, we really have already. As soon as we write that journal entry, we've reduced the net book value of that, because the net book value is calculated as the purchase price minus the accumulated depreciation for that item. So that's exactly right. That's it. Awesome. Now what? We've got 15 minutes to finish this mess, don't we? There's 2 left. Katie, are you here? Katie is not here, is she? So that means we get to talk to Ekta even sooner. And she doesn't look very excited to be called upon right at this moment. What numbers are we missing, Ekta?
Sales revenue and raw materials.
Requisitioned is that word. Raw materials requisition. Which one of those 2 would you prefer? She's like, I don't want to do either. You don't know what requisition. Would you like me to be helpful? I'm happy to be helpful. Requisitioned comes from, I think, the root word request. Okay? So who might request direct materials? Or raw materials in this case, which is the same thing for purposes of this particular problem. You, right? In our example of our t-shirt manufacturing, who would request raw materials or direct materials? You would, the people doing the work. Where are the people doing the work at? Where are the people doing the work at? In this room. And which T account is this room? The work in process. And so when direct materials requisitioned, which arrow is going to be the direct materials requisitioned? You're so close. You're very close. The inventory. From which inventory? To? Very good. For how much? $240,000. Very good. Whew, see how easy that was? Now that once you know what requisitioned means, requested, it's a long way of saying out. Okay? Holden. You're next. And there's only one left, so unfortunately you don't get any choices. Revenue. The very first number, it got skipped over. The very first number got skipped over and is now fallen clear to last on the draft board. You're not real sure.
It's got to be. Well, it's not any of the product costs.
Correct. It's not any of the product costs.
It'd be in the income statement, right?
Must be in the income statement. So
What goes in the box, you may.
no, what goes in the box is coming down the arrow. Okay, so revenue. How do we increase a revenue account?
Credit.
Yes, we credit a revenue account to increase it. So which side of the T account do you think it's going to go?
I mean, right side, sorry.
Right side, credit side. For how much?
$940,000.
$940,000.